Hey there, future CMAs. Welcome back. As your experienced CMA coach, I am just so pumped you're here with me today. Okay, let's dive right into this. Today, we're taking on a topic that sits right at the very heart of managerial finance. We're talking about activity ratios, which, you might also see referred to as efficiency or asset turnover ratios. Listen, if you're prepping for Part 2, Section A of the exam, mastering these concepts is absolutely non-negotiable. It's one of those areas where you can easily pick up points, but it's also where candidates can stumble on some very specific sneaky traps. To help you navigate those traps perfectly, here is our roadmap for this explainer. 1. Why asset efficiency matters. 2. The working capital journey. 3. Total asset turnover traps. 4. The cash conversion cycle. And 5. Our exam day survival guide. All right, Section 1, Why Asset Efficiency Matters. Now let's keep this super simple and draw a really sharp contrast right off the bat. We've got liquidity ratios on one side and activity ratios on the other. Liquidity ratios are asking a very immediate, right now kind of question. Do we have enough cash to pay our bills today? It's basically a snapshot of survival. Activity ratios, though, they're asking a far more dynamic question. How efficiently are we actually using our assets to generate cash and sales? This entire explainer is focused on that second question. It's all about the speed, the motion, and the efficiency of generating cash. To really visualize this, imagine for a second that you own a bakery. You go out and buy $10,000 worth of flour. Well, if that flour just sits there on your warehouse shelves for 6 months, that $10,000 in cash is literally trapped. You can't use it to pay your staff, you can't use it to expand the business. But if you can turn that flour into bread and sell it in just 3 days, man, your capital is working at warp speed. The ICMA loves testing these ratios precisely because they reveal how well management is actually running those day-to-day operations. Moving right along to Section 2, the working capital journey. Let's actually follow the physical journey of a single dollar as it moves through the business cycle. We'll map out exactly how working capital transforms. So step 1, it starts as cash. We use that cash to buy inventory, which brings us to step 2. Then we sell that inventory to a customer on credit, which creates an accounts receivable in step 3. Eventually, that receivable is collected and boom, it turns back into cash. The very first piece of this puzzle we need to measure is inventory efficiency. Basically, how quickly do we actually sell through our inventory? Now, here is a warning. And as your coach, I really need you to hear this loud and clear. Crucial CMA trap number 1. When you calculate inventory turnover, you have got to look very closely at your numerator. It must be cost of goods sold. Do not use revenue. Why? Well, because inventory is recorded at cost on the balance sheet. Matching revenue, which inherently includes your profit markup, against your inventory at cost will completely distort the ratio. You're comparing apples to oranges. So always pair cost of goods sold with inventory. So once you have that turnover number, you often need to convert it into actual days to truly understand the timeline. That gives us DSI, or days sales in inventory, which tells us exactly how long inventory sits before selling. And once it's sold on credit, we need to know how fast customers pay us back. That's measured by DSO, or days sales outstanding. Think about it this way. If your calculated DSO is 45 days, but your stated credit terms are net 30, what does that tell you as a management accountant? It immediately tells you that your collections department is falling behind and your precious cash is unnecessarily tied up in customer credit. For both of these metrics, higher turnover and lower days are almost always better. All right, Section 3, Total Asset Turnover Traps. Zooming out a bit, the broad metric here is total asset turnover, which is calculated simply as revenue divided by total assets. This metric tells us exactly how many dollars of top-line revenue the business generates for every single dollar it has invested in assets. Now keep in mind, this will look very different depending on the industry. A highly capital-intensive company, like, say, a massive steel mill, might have a turnover of maybe 0.5. Meanwhile, a super lean software company with barely any physical assets might boast a turnover of 2.0 or even higher. Okay, pause. Lock this next part in because this is crucial CMA trap number 2, and it is exactly where thousands of candidates lose easy points every single testing window. Whenever a financial ratio combines an income statement item, which covers an entire period of time, like a full year, with a balance sheet item, which is just a static snapshot at a single point in time, you absolutely must use the average balance for the denominator. Here is exactly what I mean.
If an exam question gives you both 2025 and 2026 balance sheet numbers, please do not just blindly grab that 2026 ending balance. Because revenue was generated throughout the entire year, you have to average the beginning 2025 balance and the ending 2026 balance together first. Only after you find that average do you plug it into your denominator. Just memorize this rule right now. It applies across the board for activity ratios.
Okay, Section 4, the cash conversion cycle. The cash conversion cycle, or CCC, builds on everything we've talked about. It measures the exact number of days it takes for a single dollar spent on raw materials to travel completely through your operations and return safely to your bank account as cash collected from customers. Honestly, it is the purest measure of working capital efficiency. This is a formula with 3 moving parts: DSI plus DSO minus DPO. Let's break it down. First, DSI is how long inventory sits. We obviously want this lower. Second, DSO is how long customers take to pay us. We definitely want this lower too. But third is DPO, or Days Payable Outstanding. This is how long we take to pay our suppliers. Notice that minus sign? Yeah, we subtract this because holding on to our cash longer is a massive advantage. The longer we can safely delay paying our suppliers without any penalty, the shorter our overall cash cycle becomes. To show you how powerful this is in the real world, let's look at the Amazon advantage. As a general rule, the shorter your cash conversion cycle, the more efficient your working capital management is. But companies like Amazon have optimized this so intensely that they actually operate with a negative cash conversion cycle. No way, right? But it's true. That means they collect cash from you, the customer, weeks before they ever have to actually pay the suppliers who provided the products. They are essentially using their suppliers' money to fund their own operations. It's a completely brilliant strategy, and honestly, a negative cycle is the holy grail of activity management.
Finally, Section 5, our exam day survival guide.
Let's distill this entire lesson into a highly structured, foolproof checklist you can rely on when that exam clock is ticking. Here are your 4 golden rules to lock in right now. Rule 1, always pair cost of goods sold with inventory and net credit sales with receivables. Keep those accounting bases matched. Rule 2, always calculate average balances for balance sheet denominators when you're pairing them with income statement numerators. Rule 3, memorize the CCC formula, inside and out, DSI plus DSO minus DPO. And Rule 4, pay very close attention to the day count convention in the word problem. Always use 365 days in your calculations unless the exam prompt explicitly tells you to use a 360-day year. That tiny little detail can change your answer just enough to make you select the wrong multiple choice option. Listen, studying for Part 2 of the CMA takes a massive amount of dedication, but I want you to remember exactly why you started this journey. Every single formula you master, every trap you learn to avoid, it brings you one step closer to putting those 3 letters after your name. So I leave you with this final question. Are your assets working as efficiently as you are studying? I challenge you right now, as your coach, don't just close this explainer and walk away. Go conquer 10 practice questions on activity ratios, right this second, while the logic is completely fresh in your mind. Prove to yourself that you've got this down. Keep up the incredible work, and I will see you in our next explainer.